Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that it could be a bit confusing, misleading, and take us off course and help to make it actionable, understandable, and clear. What a week, and therefore, what a show. I got a little hoarseness in my voice. Forgive me. Soon the AI will just overlay this. I just haven't quite figured that one out. However, we've got some really interesting content, in particular about presidents in the USA's history and what sort of returns that have been experienced in that time. We'll look at two different ways to look at it. We also look at one of my favorite topics, the ways in which your financial custodian, that's the Fidelity, the Schwabs, the Vanguards of the world, are out to get us. That's right. We look at a harrowing tale from a Wall Street Journal article that I also will delve a little bit into Robert's Corner to help us be wise as serpents, innocent as doves. And then on one of our favorite topics, we elevate hedge fund fees and what it is they are actually doing for clients. But at the top, because I know it's on your mind, we have a new president in our country. I'm starting to get this question. Not a lot, though. I'm not a ton, but now that Trump's in office, can we anticipate returns that are above what we've experienced historically? Well, let's break it down. There are two different ways of looking at it. Mr. Morgan Housel on X platform came out with an average annual real stock market return of various presidents. And then Creative Planning's Peter Mallouk also came out with a different way to look at it. I want you to think about this. You might need to bring folks in around the table. What president has experienced the greatest average annual real total stock market returns in our country's history? Now, of course, George Washington was not trading stocks, although if he was, I think he would have been an index man, candidly. But this is interesting. Calvin Coolidge comes in at 29.1% average annual real total stock market return, and that's right, he was a Fiji. And he has a great quote on persistence. Going down the list, Ford at 16.7, Harding, of course you guys probably remember Harding, 16.1, Obama, 15.2%, that's per year, Clinton, 14.2, Eisenhower, 13.9, Reagan, remember Reaganomics, 10.7%, George H.W. Bush, 9.4%, who is at the bottom? Hoover, negative 19.2%, Nixon, negative 7.6%, George W. Bush, negative 5.5%. Now, for the astute ear and the sharp mind, what you can probably discern from this data is timing has a lot to do with it, doesn't it? Yeah. If you entered your presidency in the year 2000, that was going to be a tough slog. Tough way to get good returns. Whereas if you entered your presidency in a down market and great way to do it. Mr. Peter Mallouk had a different way of looking at it. He looked at some of the greatest runs. So by your entire term, meaning not the annual returns, but who had the best run. And there were, poor George W. Bush had some bad runs. 2001 to 2009, that's a rough data set. But Obama in his first term up 102%. 2009 to 2013, that's timing. So what's my summation of all this? It's be very suspicious of anyone telling you, oh wow, yeah, we've got a president in here for whatever reason in their mind. They think that the stock market will do wonderfully under this president, whereas it would have done just terribly under another president. That's not the way it works. The stock market is a predictive machine. It's anticipating how good the economy will be. The president, and they're not a king. They're not the potentate. They can't just dictate. They have a whole lot of controls in America. So stay the course. Stay the course. And then this article may make your blood boil. It's just really, really important that we understand what's going on in the marketplace. This is a Jason Zwig article headlined, "What You Don't Know Could Sting Your Portfolio." Subheadline, After all my years of writing about investing, I had no idea what was going on behind the scenes. I doubt you did either. Now, you might know as a listener of this market update, but Zweig starts off, your financial advisor may have a conflict of interest that you would never even think to ask about. Zweig continues, advisors are required by law to act in your best interest. They can sometimes be pushed to do otherwise, though. The latest push comes from an unlit corner of the financial industry. All right, so what's happening? Zweig gives a story about Mr. Mark Armbruster, who manages $900 million for his firm. And these firms, so this can be a little confusing, but there are these financial advisory firms. That's a bunch of people who get together and say, I want to manage money. But they use something called a custodian. That's the Fidelity, the Schwabs, and the Vanguards of the world. But they're just the advice shop. They're using the custodian to place the trades, keep the records, et cetera, et cetera. What's happened over time is some of these custodians, the Schwabs, the Fidelities, they haven't made as much money being custodians. And so what this advisor said he was asked to do by Fidelity was a Fidelity rep called this guy. He said he needed to generate 90 grand more in annual revenue. What? What's going on here? Fidelity then explained to Mr. Armbruster, who again manages $900 million, the different ways he could make more money for Fidelity and stay in their good graces. Because there are all these associate costs that Fidelity has to bear to help administer these accounts. So they want to make sure they're making adequate dollars. They suggested, this rep for Fidelity suggested something called an asset shift. You're moving investments that are run by Fidelity into Fidelity investment affiliates, meaning, hey, maybe your investments were here in this other company, move them over into Fidelity has their own products. Would you move them to our products? They also suggested moving client money out of a high yield fund into a lower yield Fidelity cash fund, F-cash, that yields 2.1% instead of the money market rate of 4.3 or 5 or whatever. This is Fidelity. Asking the advisor to move the client money in a way that benefits Fidelity, not the client. Did you get that? Again, Fidelity is calling the advisor who has discretion. That means they're able to move your money around without you having to do anything. I do not have that hourly financial advisor. I just give you advice and you execute. No discretion for me. No custody for me. This is not surprising, but still appalling. So Zweig says, Fidelity is a firm I've long admired. Oh, by the way, me too. They've a lot to be proud of. They've accomplished a lot. However, Zweig reminds us, hey, an advisor is supposed to act in your best interest. And oh, by the way, the fact, if this guy that manages $900 million in custodies at Fidelity, if he had not gone to the Wall Street Journal, no one would have known. He would have moved client money around and probably had some explanation for why they did it. Oh, we just felt it was safer. Or the F-cash program's a great program. Who knows what they would have said. I have experienced this with Fidelity. I think I may have mentioned this story. I'm in my office, put it on speakerphone. A client of mine said, hey, Fidelity's been calling me. Single person, older woman. They keep wanting me to do this thing. And I don't, okay, great, bring it in. We'll just call them together. Okay, great, call them together. Fidelity, and by the way, we've put her in low cost Fidelity products, meaning like 0.01% expense ratios. Like she's in all low cost stuff. So I've set up the portfolio perfectly, of course, in my opinion. Excuse me. Fidelity says this is a big problem. Ma'am, huge problem. You're in suboptimal products. We have different Fidelity products. Oh, by the way, they were over 10, 20 times as expensive. These various convoluted, actively managed Fidelity products. And the Fidelity advisor, no, I'm on the phone, by the way, introducing myself as an hourly advisor. Hey, I'm her hourly advisor. Oh, yeah, do I have permission to be on the call? He's got permission to be on the call. This guy, kudos to him in a sense, the courage, just keeps selling, doesn't stop, hammering. It's like he's reading a script, and he's her advisor at Fidelity. Now, in this story, this is a third-party advisor, some different company that's using Fidelity as a custodian. But you see what's happening? The example I like to give is if you Google, this is just a fun one, Fidelity target date funds. Just Google it. Try it. Where does it take you? They have a high-priced version of Fidelity target date funds. The funnel is going to drift you into the product that costs 0.75% instead of the Fidelity target date fund that costs 0.12%, which, by the way, it's all the same stuff. So you're paying 6 times or whatever for the same stuff. So it makes us remember we have to do our own mind work, as the great Charlotte Mason once said. All education is self-education. The days of just calling up a financial house or a bank or a brokerage, and by the way, these days never existed. Never. But they really don't exist now. Just calling up and saying, hey, what should I do with my money? If you do that, I can tell you where you're headed. You're not headed to the 0.01% product at Fidelity. You are headed to the high price. And it's not just Fidelity, by the way. I'm grateful for Fidelity. Wonderful platform. A lot of wonderful people work there, contribute to North Texas economy. Grateful for that. It's Schwab and it's Vanguard increasingly. They see pools of money, and they don't make, these custodians do not make a whole lot of money if you just buy index funds and do nothing else. In fact, they make no money on you. There's no profit. There's no profit for them. That's not your problem. That shouldn't keep you up at night. You let them figure out how they want to make money. But the solution is education and a guide, because it is very difficult. We might all talk tough. It's very difficult when you get in a room or you get to a nice steak dinner and someone tells you about a wonderful product that 10 times more expensive than something else they sell. Be wise, wise. And then in a similar vein, this is a Wall Street Journal article by Caitlin McCabe, headlined, "Hedge fund fees eat up half of client profits." That's a lot. I feel like half is a lot. Over the subheadline, "Over the past 2 decades, fees have amounted to more than 50% of gross gains," LCH research finds. So this new report that came out really helps clarify what a lot of people have been saying, that, this can't be worth it. Can't be worth it. Hedge funds, check this out, have earned $3.72 trillion since the late 1960s, and they've kept nearly $1.8 trillion of that in fees. Guys, I'll say that again. Since the late 1960s, I guess that's the genesis of the modern day hedge fund in some form or fashion, they've earned $3.72 trillion, and they've kept $1.8 trillion of that. Now, maybe the lesson there is you need to go start a hedge fund. Seems like you get half the rake, but the worsening ratio of hedge fund gains reflects how many hedge funds have moderated in recent years, while fees have crept higher. Many firms take a management fee of 2%. So that means if you've got $100, they take $2 of that, plus a performance fee equating to 20% of fund profits. That means if they made $10, they take $2. So the management fee happens no matter what, and the performance fee happens if they make money. And some charge more. So Citadel is a famous one; they charge more. They have incredible profitability if you own the hedge fund, and not a lot of fun for the investor. So this LCH, they compile the report, and apparently this data is not easy to get. No surprise. So we may need to back up a bit and give a definition of a hedge fund. It's a private pool of capital that seeks returns. Its historic definition was hedge. Why the name hedge? Hedge in the sense that it will zig and zag when the market goes up or down, meaning it is hopefully market neutral. So as the market goes down, hey, you're hedged. You've got some sort of a hedging mechanism. If the market goes up a ton, you're really market neutral in that you can make money irrespective of market movements. That was the appeal. My opinion and my view is that it's kind of whatever now. Certain hedge funds may do that. Some don't. Some seem to act like actively managed mutual funds. Others have special situations that they take advantage of. But apparently there was a letter, which it cracks me up. Industry fees have long been contentious, the article explains. In an open letter last year, dozens of investors and hedge funds demanded changes to how managers are paid. On fees, LCH, the group that did the report, the top 20 managers have kept 34.3% of gross gains. less than the rest of the industry. That reflects higher gross returns, more stable capital bases, and their tendency not to generate large drawdowns. Great. So apparently the big ones maybe are a little better. I would tell the folks who wrote this letter, which is admirable, you can just leave. That's sometimes the best letter, voting with your feet. Oftentimes, if you're writing a letter, they kind of have you. It means you may be stuck, maybe a little stickier than you'd like. Now, for those investors in the hedge funds, they may be asking, well, what do I do if I really don't want to experience the low lows of the market, which is typically what they mean? They're happy for the high highs of the market. Well, you could always buy bonds. This is the John Bogle solution to your volatility problems. You can just buy fixed income or bonds. Historically, bonds have provided a hedge to market action. Not all the time, admittedly, not all the time, but if you truly are worried about that and think you might need the money, it is a much better play. And you know what the bond fund cost at Vanguard? It's like 0.03%. A little different than 2%, which is effectively 200% versus 0.03%. So much, much lower. So simplicity. You know the moniker. You know why we do it. It's for these reasons. It's so that you don't end up having to write letters to the folks managing your money asking for them to reduce the fee. These are folks that need to listen to the podcast. And as you know, the podcast will not stop telling you to keep those costs low, that investing simple, and your time horizon long, because that's what's going to give you the best shot on your investing journey. Until next week.